Likoni Two Rivers, East and Central Africa's largest and most preferred shopping center.
Yes, hello, check 1 2. Hello, check 1 2. 2. Hello, check 1 2. Hello, check 1 2. Test 1 2. Hello, check 2.
Karibuni to Rivers, East and Central Africa's largest and most preferred shopping center.
Good morning once again. I'd like to welcome you to this year's full year investor briefing and results release for the financial year 2019. Before we get things going, allow me to ask our Managing Director, Centum Capital, to come and open with a word of prayer.
Good morning, everyone. Welcome to this investor briefing breakfast. I trust you've enjoyed the breakfast and continue enjoying your breakfast. Please say hello to the neighbor next to you. As is usual fashion on Sunday mornings, tell them welcome. Tell them they've been greeted by the pastor. Let's pray. Heavenly Father, we come before you this morning. We want to thank you so much for your mercies which we see anew every morning. Thank you, dear Lord, for the company Centum, O Lord. Thank you, Father, for the founding fathers of this company. Thank you, Lord, for the shareholders. Thank you, Lord, for the investors. I want to thank you, Lord, even for the management, O Lord. Thank you for the year that has been, the year ended March 2019, O Lord. I want to thank you, Father, so much for your graces and mercy that we saw throughout the year, O Lord. I want to thank you, Father, Lord, even for the results that we are going to be announcing here today, O Lord. I want to say all glory and honor to your name, Father. I want to thank you, Lord, for the country of Kenya, and we pray, Father, that you're going to continue to keep us, and may you bless this land. In Jesus' name we pray.
Thank you very much, Fred. On a light note, that wasn't written or rehearsed, so I'm even wondering, had I given him a week, we would have been here for a while. To get things going, allow me to welcome the group CEO. I think he is eager enough to present to you the results. Yesterday, I had him mention that he can summarize this into 3 statements. So I look forward to seeing those 3 statements over the period of 1 hour. Thank you.
Thank you, George, for that kind introduction. Thank you, Muremi, for those wonderful prayers. I've known Muremi for a long time, and I've always known him to be a prayerful man, so he never disappoints. I'd like to take this opportunity to welcome each and every one of you. There's people in the room today. I'll introduce some of my colleagues on a need basis, depending on whether I'm referring to your slide or not. And also I'd like to welcome all those people who are joining us on live streaming. There are a lot of people I know who are joining us online for this particular presentation. Today's presentation is personally a special one for me because it's my 10th investor briefing. So the first one was in the results for March 2009, and we've come a long way from March 2009 to now March 2019. And I was chatting with my friend Ali Khan just before this, and he reminded me of a mind speak. Actually, that's the only one he invited me, which I attended, which was sometimes, I think, either in December 2008 or January 2009. And we made a number of, I made a number of promises at that time. And so I leave it to those who watch that to see whether we've lived to that promise. So this particular briefing will begin off with a recap of the last strategy, Centum 3.0. We came to an end. So we had the 2.0, which ran from 2009 to 2014. Then we had 3.0, which ran from 2014 to 2019. And now this year we've just begun Centum 4.0, which is going to run from 2019 for the next 5 years. So I'll do the presentation with my colleague Sam Kariuki, who is right there. So Sam is the outgoing CFO. He's taken over the responsibilities of leading the real estate business, and the incoming CFO is Lamek, who is right there. So Sam, this is a special moment for him because he'll be making his final investor presentation, presenting the numbers. He's delivered very consistently. So we wish Lamek all the best, and we're sure you'll do just as well as Sam has done, if not better. I'm sure Sam does not mind if Lamek does better. So for Centum 3.0, we had 5 pillars. The first one was on return, and the goal was to deliver a return that exceeds the market. I think over the last 5 years, NAV has moved from about 22.9 billion to 52 billion. So So that represents about a 20% annualized return. We had a focus to be active in 6 sectors, which we've been. We had a goal to scale up our asset base. When we began in 2014, it was a 28 billion company. Today it's about 72 billion shillings. In 2009 it was 6 billion shillings. So we've come a long way. There was a pill on brand, there was a pill on cost. Our ceiling was 2%. We're now closing at an average of around 1.5%. So generally on track. You can see the asset growth, you can see the net asset value per share growth. We're now at about 79 shillings per share. Somewhere along the line I'll speak about the steps we'll take around the share price. It's a source of frustration because it's around 32 shillings. So it's significantly lower than net asset value per share by about a half. The scorecard, what has driven this? We've largely grown the business organically. We've moved from where we started off at 6 billion to 70 billion. I remember when we had the first strategy for the company, we had ambitious goals, and the question was how will we finance these goals? And I asked a question as a naive incoming CEO, am I going to get capital from the shareholders? Many of my colleagues in subsidiaries, whenever we meet for business review, they speak about capital injection by the shareholder. And I was promptly disabused of that notion. There was no capital forthcoming from my shareholders. I then asked, can I raise capital from other shareholders? And then that was also politely declined. And so the options available are organic growth and to work with our lenders to grow the balance sheet of the business. And therefore that's what we've largely done. And therefore we've had to make investments, exit, and then recycle those profits back into the business. So over that period, we've actually the only share increase we've had is on account of bonus shares that have been issued twice. We had 2 debt fundraisings, bonds. The first one matured in 2017, which was redeemed. We issued one 5 years ago in 2015. It's maturing next year in June, and our intention is to redeem it as well from internally generated funds. And of course, we've worked with our lenders, many of whom are here, on various projects. The objective is that by June next year, when we redeem the bond, is that Centum should be debt-free at a CICL level. And therefore, the share value, the total assets will be equivalent to the net assets. So we'll roughly be around 60 to 70 billion without any debt. We've been spending about 1.8 billion, 1.9 billion in debt service. And the idea is to pay that out at CICL level and have that cash flow available either to boost the dividend income, or given the price where it is today at 33 shillings, I think it's a wonderful investment opportunity for Centum just to buy back the shares. But then you have annuity income in which you can have a share buyback program, which hopefully will see the price then progressively converge to closer to net asset value and reduce the discount that we currently have. On the private equity business, the overall return is about 33%. The IRR, there's a business that Fred leads. There have been a number of successful exits in the period. So far, Fred has realized about 22 billion. Actually, the gains are 22 billion. He's realized about 22 billion in the last 5 years in that business, and we've invested in a number of businesses. I see some of the leaders here. We invested in the bank. Chege is here. Chege is there, and Douglas are there. So if there is anyone who has a question on banking, those are the 2 people. Whoever has a microphone, please take note who is going to respond to those questions. We invested in Almasi, and I've seen Wambua around. So Wambua is right there. Wambua used to work with us, and we seconded him to Almasi, and he's done a wonderful job. So if anyone has a question on that, Wambua can respond, and a number of others. On the real estate business, the return has been 37%. That is 2 Rivers, Palmarina, Vipingo. The good thing is that both Vipingo and Palmarina are debt-free because those were funded from Centum. And then we have 2 Rivers Development Limited, where we are a 58% shareholder. We have a number of other partners in that particular investments, and then the marketable securities portfolio. You may have seen today that we signed an agreement, I think on Monday, to sell our shares in Almasi and bottlers. That is at a price of 19.5 billion. We are carrying it in this particular balance sheet at around 16 billion. And our cost of acquisition is about 3 billion. These are businesses that as you're aware, we've been investing for a long time. We began by consolidating the various assets, the various bottlers. We raised our shareholding in Almasi from about 27% to 54%. And I think it's a positive outcome for the business, but also for us as an investor in that business and for the rest of the investors in the business. And we intend to utilize part of these proceeds to retire our entire US dollar denominated debt. It's about $75 million. That will leave about 120 or 12 billion shillings, which will be deployed into the private equity and marketable securities portfolio. That redeployment will save us about 700 million shillings in annual interest costs. We are earning roughly about 400 million shillings in dividend, and that saving excludes any additional income we'll realize on the 12 billion over and above the amount that we've used to retire the debt. We expect to complete this transaction probably in another, it's subject to regulatory approvals, so probably in another 4 months we should be completed. So within this financial year, we are targeting to complete the transaction. Bobby, you may take my chair there. Okay, thank you. That's Bobby, was my vice chairman when I served on his board at the NSC, so welcome Bobby. Yeah? So Centum 4.0, we finished 3.0. I just want to speak briefly about our strategic focus in the next 5 years. So our focus has shifted. Over the last 10 years, it's been largely an asset growth strategy, because the way the economic conditions were, they were ideal for asset growth, where you make an investment and you drive growth in the value of the asset primarily, and you then exit. However, looking at our outlook is that our focus now is shifting to more moving towards cash annuity businesses, so being more cash generative from the annuities of the businesses, as opposed to relying on exits. Because for you to get that value growth, you need a very robust economic growth to underlie the growth in earnings, because the only way you get growth in value is if you're able to achieve a growth in EBITDA or underlying earnings without a huge deployment of additional capital. So if you take an example of Almasi, when we did the merger in 2013, the profit after tax was just slightly over 100 million shillings. Today it's over a billion shillings. So there's been huge growth in the underlying profitability of the business. So our focus is more on cash annuity income. It's about conserving liquidity. That's why we have taken a view that we should not have any debt at the Centum level, the holding company level. We've also, in keeping with the theme of the country, there's been significant evolution in the business. So Sam and his team have their own balance sheet. That's a real estate team. Their balance sheet is roughly about 30 billion shillings. I joke with Sam that it's 5 times larger than the balance sheet I took over when I took over CEO of this business, because mine was only 6 billion shillings, 10 billion shillings of cash, and 180 billion shilling overdraft. So we started off with a 30 billion balance sheet and zero debt, and therefore any financing is then done at that level. The same applies with Fred. Fred is managing our Fund 1. He's now also raising a Fund 2, targeting to raise about $500 million, and will match what he puts in. For every 10 shillings he raises, we'll put in, is it half a shilling? So it's a performance-based sort of investment program, and he's working with his team on raising a second fund, and then there's marketable securities. We deployed considerable capital in development of projects. We had a development of business. These were the power projects came in. However, of all our 4 pillars, the one that has performed the least satisfactorily is the development side of our business. These are the 2 power projects. They have taken a lot longer than we had expected. And going into Centum 4.0, we are no longer going to be focusing on the development side of the business. So we're going to focus on just 3 areas: our private equity business, our real estate business, and our marketable securities business. Our focus in line with that is around return and dividend payout, because this business exists to create value for its shareholders. and therefore the focus around one, the immediate objective is to try and close the gap as much as we can between the price and the NAV. I think we're going to be able to do it. We have a solid plan around that. So it's also related to the second point around capital structure and liquidity. Retire all the debt, and then you're able to conserve whatever liquidity comes through, pass it back to the shareholders, either through dividend or share buybacks. Operating costs are now not as a percentage of assets, but they're as a percentage of annuity income. The ceiling is 30%. We are currently at around 18%, and I don't see that going increasing beyond that level. There's a whole pillar around organization effectiveness, driven by a man called Thomas Omondi, who is sitting right there. He's a director of operations, and then there's a focus just on those three lines of business. And each of these lines has a leader, they have a team. So at CICL level, we are now down to, Thomas, we're now down to 3 people. So at CICL level, it's now back down to 3 individuals. I hope we'll add value. I hope those 3 individuals, myself included, will add value. The portfolio review, so there's real estate, there's a private equity portfolio, marketable securities and development. I'll just speak on real estate. So they're doing the business, all the activities they're doing is, the drivers are 4. One, they have infill projects. This is where they have taken our land banks and they're doing various infill developments. There's land monetization. That's a sophisticated way of saying they sell land there. Then there's rentals. Rentals is, for example, Two Rivers Mall, the offices. And then there's third-party projects where we're also looking now to partner with third-party landowners so that you don't have the capital drag of owning land. But because our business is market-driven, so this business is around addressing demand. And so it's a demand-driven business rather than a development-driven business. And therefore you go where demand is and where the customer is. And you may not necessarily have land in those locations, but you have the ability to develop, which is the capital, the project management ability, and the ability to sell. And therefore there are a number of projects that will be launched shortly. There's been a lot of work that has been done in various locations in this country, and which are largely very affordable, targeting the mid-market segment. And the results so far have been very encouraging, despite a very challenging economic environment, as we'll see shortly. So in total, right now, they are developing about 1,200 houses under construction. Of those, they have sold 606. And as you can see in some of the projects, the sales are as high as 84%. And these are largely sales that have taken place off plan prior to completion of construction. The value of the sales to date is about 5 billion shillings, and that's probably in a span of the last 9 months. So this is what has been achieved in the last 9 months. So there's a lot more that's going to happen, but the idea also is around market leadership. So they have a leadership at the price point, and also you have leadership from a quality point of view. So this is not a high margin, low volume business. It's a high volume business where you're able to churn out projects at scale. Sam always assures me that capital is not a constraint. He's one of the few Kenyans who can say he's not in a fortunate position not to be constrained for capital, and I can confirm that because a few weeks ago he took me on a roadshow with his lenders and investors, and we were very well received. So I can confirm the man has access to capital, and I can see some of them in the room. So these are some of the developments that are coming up, and we'll be seeing them completing very shortly. They've been very well received in the market. On his land sales pillar, so far last year he sold about 875 million worth of property, and this is at significant value uplift to what the carrying values are. And the negotiation is about 4.2 billion, and you have expression of interest of about another 9 billion. So this sort of is a leading indicator of what you can expect in terms of completed sales in the coming year. Rentals is Two Rivers. That is, it's doing well. It's 79% leased. The offices are coming along well. I think going forward, rentals will be a smaller pillar of our real estate business. The focus is around, in line with the theme around cash generation. We don't want to tie up capital. We want to be able to sell and get back your capital and recycle it as quickly as possible. So that is the span of his business. So next year, what can you expect from him? I expect that number not to be 1,200. In fact, his goal is 5,000.
So we expect to see a lot larger coming a number there in terms of sales, in terms of also under construction. That number should have increased. Hopefully by when we meet same time next year, you should have a few of the developments. Some of them we should have handed over by that time. We expect to see a bit more land sales, and I'm sure the rentals will have done better, and some of the third-party projects will have been launched. So that's a scorecard I've signed off with Sam. I've just shared it publicly. So Sam, you can share this with friends and family, so that they can support you in that objective. Private equity. This is Fred's business. So he has a varied portfolio. The strategy has been simple: invest in companies, increase the value. You drive value through increasing underlying earnings. So by growing return on capital. So earnings have to grow faster than the rate at which you're deploying capital into those businesses, and realize that value through exits. So it's about a cash-to-cash return model, rather than just booking book returns through revaluations. So okay, so we've had a fairly good track record of investments and exits, and in fact, Fred tells me that in this market, he claims, I think he has some data to demonstrate that he has addressed this issue of exits, because a lot of PE managers cite exit as one of the challenges. But over the last 5 years, we've had more than about 5-6 exits, all very sizable, and many of them with an IRR, even in dollar terms, of greater than 25%. So, and again, through progressive return through dividend payments. So right now, that portfolio, there's NAS, there's Isuzu, there's Longhorn, there's Sidian Bank. Obviously, Almasi and NBL will be getting out shortly, but all doing well and all pointing in the right direction. This is his track record of exits. Thanks, Fred, for including the numbers. So it's evidence-based, so you can see what has been achieved in the period and the kind of exits that have been achieved. So the portfolio is relatively small. When we started, it was less than, even in 2014, it was less than about 6-7 billion. And a lot of that value has been realized organically, and the reinvestment has been largely organic. So last year, because if you're not growing the profitability of the company, you cannot grow the values of the company. So last year, 75% of his companies had a positive profit after tax, means they made money. In simple terms, 63% paid a dividend, and 75% of them had higher profits than the previous year. So there was growth, which was really what you're looking for. There was some investment activity. We put in some money in Sidian Bank in the rights issue, and Sidian Bank also raised a Tier 2 facility, 1.2 billion. So Douglas tells me now he's going to be returning capital back. He doesn't need any more capital from us. Douglas, you should take some counsel from Wambua, who has done a good job. Since he went there, we also gave him about 1 billion shillings. Wambua, that's true. And he's done very well. So I think Douglas is following in the footsteps of and the track record of Mr. Wambua at the back there. We completed the exit of Gen Africa last year. This is something we had spoken about. When we met last, we had not completed. This completed. That was a 30% IRR by the time we were done, about 29% IRR. So his priorities now is to raise a second fund. So we'll be investing in this fund alongside other investors. I think it's positive for several reasons. One, you'll have a longer time frame. A lot of these exits have been done, investments and exits have been done within a very short window of about 5-6 years, which I meet a lot of my private equity colleagues who complain about 12 years, and I say I wish I had 12 years to invest and exits, because here you're investing and exiting within a very short window. So they'll have a longer window, and what we've tended to find is that we've had more investment opportunities than we've had capital, largely because a lot of operating partners do not see us as a financial investor. We are rather a local strategic partner. There are not many of those in the country. So we don't have enough capital to deploy to all the opportunities we have. So it makes sense if we're able to leverage third-party capital as well to invest alongside ours. The third reason is risk mitigation, because then there's greater diversification for our own investments in this particular fund. So it's going to be a focus fund, largely, I think, larger ticket transactions, couple of maybe 20, $30 million and above. And so I know there's tight liquidity. Many of you are financial intermediaries. So if any of the companies meet Fred's criteria, and roughly Fred's criteria is that it should have an EBITDA of about $5 million and above. It should have some degree of market leadership. Fred does not have any management, so will not bring any. Ticket sizes of 20 million and above. Fred, I can share your mobile number. Please call Fred. He might have some liquidity for you. He also is not, he has access to capital. So he's looking to deploy. And I think the environment is good because there might be companies that are looking for balance sheet restructuring. Probably they have a bit of debt. They need equity, but the underlying franchise is good. And that was the case even with Almasi when we took over. It was saddled with the debt. We put in rights issue. They paid back. Today they're actually cash positive. The cash exceeds the debt by about $10 million, and that freed them to then focus on their key operating businesses. So there are a number of opportunities. So Fred, let's see if anything comes out of this call for requests for expressions of interest. Yeah. So marketable securities. This has been for those of you who know Centum long enough. This used to be our core business. We had 60-70% of our portfolio in the stock market. Those days when I was an investment manager, I used to talk to Bob Karin about twice a day because we're really traders in the market. This is something we have de-emphasized, largely because the focus of the business should be to give investors access to otherwise inaccessible investment opportunities, and therefore we didn't see the rationale of investing in marketable securities in our market, especially when investors can go and invest directly. But what they have done is that there's been geographical diversification as well. So they've invested across the continent, and it has given us liquidity. So I can see the numbers there. They have generated about 13%. Is that over 5 years? Average return. But as you know, the markets have not been good even over the last 5 years. So it's been a tough market. So we're happy with the progress. We may deploy more capital there, but largely probably to the fixed income side of the business. But even when you look at equities, you can see there's huge opportunities with where dividend yields are. Some of the companies, you have dividend yields of 8%, 9%, 10%. So there's still huge opportunity. And these markets are in cycles. It's in times like this that you can acquire very sizable stakes. I remember a few years ago when we bought shares in a company called Tanzania Breweries, and we're comparing it to even our private equity portfolio. And from a valuation perspective, it was significantly more attractive, and so we took a private equity view to that particular company. Even companies like Abbasid in the past and a number of others that we've participated in. So the way I look at the market, I see we have probably gone back to where we were in 2009, and it's not a bad place to be in at this time. So that's where we are. So I want to invite my colleague Sam to make his concluding statements on his financial performance as we wish him all the best, and then we can move on to Q&A. Thank you very much, ladies and gentlemen.
Thank you, James. Warm good morning to everyone. I know it's cold. So I guess the next time I stand in such a presence, I'll be on the other side, answering questions on real estate and the performance dashboard that James has shared. I'm in a good place in the sense that already we have a good momentum going, but also I work closely with Fred Morimi, who is our resident bishop. And so when prayers are needed, I know who to call upon. All right, so I'll go briefly into the performance for the year. James has given the background, the key performance drivers. So following on from the brief he has given, those are the numbers. At a consolidated income statement level, our bottom line is up 48% from 2.8 billion to 4.1 billion. Of that, about a third is the primary private equity assets, primarily the bottlers and the publishing business, which have given a trading profit of 1.1 billion, 5% growth year on year. We have our financial services, primarily the bank, and Nabo Capital, the asset manager. We have a small leasing company called Zohari. The performance there is a 15% decline in the operating loss Obviously, as CDAN has published its financials in the last 3 quarters, it previously has been recording a loss which has been coming down quarter on quarter. And I'm happy to say in the last quarter then the business has returned to profitability. So that's a decline in the loss of that segment of the business. Then we have the core investment operations, which then reflects everything else, including real estate. There you can see our investment income is up 71%. Primary driver there is the Gen Africa exit, where our realized gain was 1.2 billion. Any realized gains in real estate from the sales that James has spoken to are booked in that line. But also there, because of the sizable properties that we hold and the activity that has been there in the last 1 year, as James mentioned, we've been selling our land at several multiples to our carrying value today. So there's an unrealized, a significant unrealized gains. It does reflect the activity, especially at Vipingo and Palmarina, where in the last 12 months we've broken ground on an industrial park. We've broken ground and significantly progressed on about 1,200 residential units. So that is reflected on that line. From a total cost perspective, largely flat at consolidated level. Then a PBT of 41%. And as I mentioned, a bottom line of 48% up year on year. That's our consolidated balance sheet. As an investment company, this is not necessarily key statement that we focus on, because all this does is to simply sum up all the subsidiaries' assets and liabilities. The core focus for us from a balance sheet perspective is the company standalone balance sheet, which reflects our share of the assets of the individual companies. So I will not focus much on that one. So then this is the company level return statement. As an investment company at this level, the focus again is the total return. The total return would be the actual cash income realized or the cash profit realized, but also importantly to reflect the performance of the investment portfolio. What we call unrealized gains are a significant component of the total return, because what this gives to the investment community or to our stakeholders is a view of the value creation activities that have gone on in the year and what we expect to realize should we sell any of these assets. For example, James has spoken to the exit that we just announced to the market. Any unrealized gains previously would have been booked in that line. Then when you realize that, it goes up to the profit. I will at some point speak briefly to the methodology through which we value our assets and which shows how conservative or otherwise that line item is. So at company level, total investment income largely flat, 3.2 billion compared to 3.5 billion last year. Having sold Gen Africa, whose gain of 1.2 billion is shown there. It then means the dividends that would have been booked in the previous financial year would not be reflected in the current financial year. That's why you see that decline on the dividend level. Also, the dividends in the prior year include what you'd call a realized gain at a subsidiary distributed upwards as a dividend. From a portfolio cost perspective, if you've tracked the way our costs have performed in the last 4 or so years, we've deliberately been managing our cost downwards. So not only are they declining as a percentage of total assets, which has been our key metric, but also in absolute value, the recurrent cost has been coming down, and so has been the one-off cost. What we call one-off costs, strictly speaking, if it were not an IFRS application, these are really investments. This is the operating expenses that we would use to drive some of the investments. For example, consultancies relating to our investment portfolio. But again, that has come down year on year. Therefore, to close with a PBT of 827 million compared to a PBT of 1 billion at company level. On the total return, flat, relatively flat, 4.7 billion compared to 4.6 billion prior year. On the side, there is a track, as I mentioned, of how our operating costs have been coming down as a percentage of assets, which is typically what a PE firm would have measured as. Our benchmark was 2% of total assets. We've managed that well downward, both in absolute value and as a percentage. As James mentioned, looking forward, given now the focus away from a capital appreciation play to a cash annuity income forecast, the benchmark then will shift to comparing costs to our cash annuity income. So that is the balance sheet of the company. That is a key measure that we look at. Total growth in assets from 66 billion to 72 billion. Of the 72 billion, largely our asset is really the investment portfolio. You can see from the 71.6 billion, about 70.5 billion is the total investment portfolio. Then a cash closing of 253 million Kenya shillings. On the liability side, and I will speak a bit more on the details on the liability side, total liabilities of 19 billion compared to 17 billion last year, of which 16 billion are the borrowings that James spoke to, and I'll give some details on that. So we closed the year with a total shareholder funds of 52.6 billion, the NAV, translating to an NAV per share of 79.1 shilling. I suppose when you look at this balance sheet, the question that follows is then, how are these assets measured, or how are they valued? And consequently then, how can one assess that NAV per share? If I then segment the balance sheet into the three business units that we are now focusing on, if I look at the 70.5 billion, the way it's segmented, the portfolio that Fred manages under private equity is about just slightly south of 26 billion. Then real estate is that I manage is 35 billion with a marketable securities portfolio of 3.8. Then development, much as James spoke to how this portfolio has performed, from an absolute perspective, as a percentage of total assets, it tends to be very small. The total maximum exposure there is only 5 billion out of the total assets of 72 billion shillings. Now, from a valuation perspective, it's a question we get a lot whenever we meet market analysts and investors. How conservative or otherwise are we? We've always put out the statement that we believe we are very conservative, and I'm happy to say that this is largely validated by our history of exits. We provide there snapshots of what we've exited in the past, what the carrying value would have been in the previous year. If I look at some of the largest, in 2015 we had an exit of our stake in UAP. We had been carrying it at 2.2 billion. The exit value was 5.2 billion. If I look at the significant one that James has spoken to, out of a cost of 3.4 billion for the combined bottlers, in this balance sheet, the carrying value is 16.8 billion. The exit that James has spoken to is coming at 19.6 billion. So in a way that validates. If you look at every single asset we've exited under private equity, we have realized much higher value than our carrying value on the balance sheet. On the real estate side, it has been previously, until last year, the two sales we had done were at Two Rivers Development, where in addition to our own development for the mall and the offices, we have two other third-party developers. Those sales done some time back in 2015 had come in at multiple, a few multiples to the carrying value then. In the last 12 months, we've closed a number of land transactions, and at Vipingo, at Two Rivers, and one at Palmarina. Those have come at several multiples, more than 5x the carrying value that is reflected on this balance sheet. And we believe we still carry them very conservatively on our balance sheet. Not only that, in this development pipeline of 1,200 residentials that you are building, obviously there's an implied cost of land when you are selling, and again that is several multiples to the carrying value. So we believe, and I suppose it's validated by market transactions, that the carrying value of those assets and consequently the NAV still is conservative. From a company gearing perspective, in terms of what I would call the long-term liabilities, two components. One is the bond of 6B plus its accumulated or accrued interest, 6.4B. We also have a USD denominated term loan of 7.5B. So a total long-term debt position of 13.8B, just slightly south of 14 billion. James has spoken to the outlook for this debt and our Centum 4.0. The $75 million will be paid this year James has touched on that. Then we expect to redeem this bond of 6 billion when it matures by next year in May. If you track how we've performed from a debt servicing perspective, a key metric there is the debt service coverage ratio, which tracks how your cash operating inflows cover your total debt servicing costs. And if you look across the 3.0 period, we've always been above the minimum covenant of 1.5. Similarly, when I look at the gearing itself, per our covenant, the gearing is supposed to be sealed at 50%. The maximum we've ever gone to is about 30%. I spoke to the maturity profile, even without speaking to that maturity profile. Specifically, we have now communicated how we expect to deleverage between now and next year, May. So what you're likely to see then is a total debt-free balance sheet at Centum level. The underlying subsidiaries, specifically real estate, which continues to be a capital-intensive business, will now be fundraising with no recourse at all to Centum. It's now a very cash-generative business unit. And finally, on the key financials, that is the statement of cash flows. Key number there to note is the net cash generated from operating activities, which is 3.7 billion Kenya shillings year on year. The end of period amount that will be shown, or not, I would call an IFRS cash flow, will always be net of NEOD. So the difference between these 144 and the balance sheet that I showed is the overdraft. And finally, on my presentations is on dividends. Since we started paying dividends in 2016, I believe, under 3.0, the policy was a nil dividend until 2019. But the board and subsequent approved by shareholders, that was changed in 2016, and consistently then, year on year, we have paid dividends. And as James said, then the outlook for the next 4.0, the next 5 years, is that at a minimum we will match the previous year dividend payout, or if 30% of the annuity income, net annuity income, is higher, that's the dividend payout that can be expected. So for this financial year, the board is recommending a first and final dividend of Kenya shillings 1.2 per share. So that's just about 800 million shillings, which is similar to what we paid last year. So briefly, those are my comments on the financial performance. I'm happy that Lamek is joining us. He's the person who will be standing on this podium in the next half-year results. We'll ask James to come and conclude on the outlook and on the Q&A. James.
Thank you, Sam, for that presentation. So we'll just have one more slide, which is the outlook. Again, consistent with the pillars for Centum 4.0. So from a return and dividend payout, our focus is around 20% return on invested capital in the coming years, and a progressive increase of the dividend payout by channeling the funds that we were previously using for interest to reward our shareholders. Capital structure and liquidity, again, you can expect that this year will reduce the debt. We don't expect to take more at the CICA level. And then as we have a number of other transactions we're still working on, so as those come through, you might see some more announcements coming through shortly, but also we intend to redeem the bond in its entirety. Operating costs, those probably will be around 15% of cash annuity income. That's the ceiling we've set for ourselves internally. Portfolio focus remain very consistent on the three businesses: real estate, private equity. You may see some new investments coming through in the coming period, probably through the fund, and then the marketable securities business. So it's a very simplified business structure. I want to thank you, ladies and gentlemen, for your kind attention, to thank all those who've joined us on live stream, and my apologies. When I sat there, I chatted with my friend Rakesh Koltask and told me it was not very clear. I hope now it's clearer. I think some action has been taken, but please feel free to ask any questions. My colleagues who are in the room, please prepare yourself to give the answers
as appropriate. So thank you very much. We are now open for Q&A. Any question? Comment? Feedback? Something we can do more? Something we should change? Where's the microphone? Matoke, any? Jan, I think you have a question? Oh, none. Okay. Any questions online? So, in the absence of any question, any comment, any feedback, I would like to thank you. I'd like to thank my colleagues for the hard work you've put in the last 1 year and that you continue to put in. To thank all our partners, because this is really a collective effort. Our bank partners, our lenders in the various projects. You know, you guys have been unbelievable, and maybe just recognize them. We have the team from Standard Bank. We've done a lot of great work with them. They're amazing. So if you're looking to do great work, I know we're also in banking, but we work very closely with them. So Standard Bank team, maybe you can put up your hand or stand up. So that's the whole team from, oh, fantastic. Oh, yeah, that's the team from Standard Bank. Netbank, which is a new relationship we have. Who else is here? Sam? Cobank. You started right at the back. I didn't see you. Then there's Cobank. You know, you guys have been unbelievable. To thank everybody, to thank our shareholders, to thank our board of directors, and to thank all of you for your support. There's breakfast is still served, and we are available to respond to any questions you have, and also to engage with some of your investors. And as I always say, you know, now we are buying shares of Centum, so please join us in buying more shares. I think it's an unbelievable opportunity. I just wish I had a bit more. I wish I was in Fred and some shoes where I had unlimited liquidity to take up this opportunity. Thank you very much, ladies and gentlemen.
Thank you very much, James. Sam, we bid you farewell in your new role. To anyone who's wondering, Sam is selling a few products. There's some brochures on your desk, or table rather. Feel free to carry them with you and just refer. Thank you once again for joining us. Those joining us through the live stream, feel free to engage through the hashtag Centum FY2019 and field all your comments. Will be available throughout the day and throughout the week as well. To our investment community, we'll be having a call today at 3:30 p.m. Kenya time. If you require any details, feel free to reach out to me or my colleague Suzanne Kilolo. Thank you very much.